Welcome to this week's market drama. We'll begin with the S&P 500, which was up 1% for the week. NASDAQ did even better, up 3.3% for the week. NASDAQ's now up 32.3% for the year. S&P is up 27.7%. This last week now, the market was up. It means that we had 3 consecutive weeks of the market going up. When it comes to economic data point, we did have a couple important data points. The first one being payroll data came out. New jobs added were 227,000, which was above the 220,000 that was expected. The unemployment rate did tick up to 4.2%, but that still remains well below the long-term averages of around 5.7%. We also had data for ISM, manufacturing and services PMI data. These are often leading indicators of economic growth. Both were in expansion territory in November. Services had been in expansion territory, but manufacturing had not. So those leading indicators do continue to show that the economy has been fairly resilient, that if anything, we've seen some signs of reacceleration of growth. So what does that mean for stocks? Well, ultimately, stocks are also driven by earnings. And the earnings picture has been fairly strong. In fact, when we look at earnings growth expectations for next year, so far consensus is 14% year-over-year growth. This year we saw 9%. I mean, the year is not over, but roughly 9% of earnings growth. So that does paint a pretty good picture, right, for the stock market of economic growth kind of reaccelerating, if anything. The employment picture, yes, is getting slightly worse than it was before when you measure, for instance, with the unemployment rate. But that means that the Federal Reserve actually might continue lower interest rates, which is favorable for multiples in the stock market. And the one area to keep an eye on here is that multiples are no longer cheap for the stock market, right? If the market's up, let's say 30%, and earnings were up 9%, that means that a fairly significant chunk of the returns came from multiple expansion, right? And now multiples for the U.S. Equity market are 22 times versus the historical averages of around 16, 17 times. So it makes it harder for next year for multiples to be the one driving. Good news is that we do see economic growth maintaining so far. There's no signs yet of a recession. And if companies continue to deliver double-digit earnings growth as they're expected for next year, we could continue to see this rally, right? So those are the levers that the market is kind of looking at as we head into the end of the year and looking into next year. If earnings continue to grow at a very good pace, market can continue to rally. If inflation remains tepid and actually decelerating, that's what the market wants to see. And if the economy continues to be resilient, we will have to wait and see for that. The one new variable is obviously a new policies when it comes to a new administration coming in. But the elections are out of the way, so to a certain extent, there's been a bit of a wash in the sense of we had a lot of uncertainty heading into that election. Now we know what the new administration is coming in. Nonetheless, it does create uncertainty around, for instance, tariffs and what that could mean for companies here in the U.S. that export a lot of their products abroad. What does that mean for them? As well as what input prices might look like for companies that need to import things from other countries in the coming years. That is it for this week. Next week, we have CPI and PPI data, which will give us a good indication of how inflation is faring. So stay tuned for that.